It's not about what you like or don't like, or you claim to morally support. I didn't support Apple. I didn't support any of them. It went up to trillion market caps anyway. It didn't need my endorsement to do that. I'm here to tell you it's going to be the exact same for the new digital system that they have to inflate up. Remember, as the one deflates, the rich aren't going to have their money all ironed out. They have transported and already positioned in the new system, and they're going to have those assets reinflated in lieu of compensation for what they're losing on the other hand. So it's kind of like the baton is being passed. They don't let go of it until they've already got a hand on the other end. Then they let go.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We are thrilled to welcome Francis Hunt, better known as the Market Sniper, a master in technical analysis and macroeconomic strategies. Francis is known for his precision in forecasting financial market movements. Francis, thank you for coming on the show.
Delighted to have you. Thanks for having me on, Steve.
Yeah, it's great to have you. Let's just kick it off. This is your first time on the show. So go ahead and tell us your story, how you got into TA and how that led to where you are today.
I think all the wrong reasons got me into trading generally. It's the most difficult way to make a fast buck, and fast buckism seemed where I was at as a young man. I wanted social proof. I wanted fast cars and fast women, and that seemed like the quick way. A couple of smart decisions, bang out, cash, be a millionaire type guy. I don't think to put it as any more spiritual or deep than that would probably constitute misrepresentation. But it started early. I felt strategic and important decision making over diligent graft in a low-paying toil seemed like a much better deal to me, and I was prepared to play the heads games and the understanding of strategy and try go for this at the executive level, out of the brain chakra rather than out of the toil and bicep level. And of course, there's many learnings to be had on that, from money management, size management, position sizing, techniques, methodology. The long and short of it is it's the longest, hardest road to a quick buck, trading and investing. And then in actual fact, you learn quickly, in no career type is there just suddenly easy money. There's a competitive market. There's a lot of smart people involved in any industries that have high rewards. And as a result, you've got some learning to do. And I got sent on my learning journey. And it ended up with me over the last 25 years developing what is now known as the Hunt Volatility Funnel method, which says you actually shouldn't be in the market most of the time. And it dovetailed with sniper analogies. That's hence why we have the sniper in there. The amount of rounds fired off in World War II that actually achieved their goal, which unfortunately is a fatality, so I'm no big hero for gold, was 250,000. And in Vietnam, they went up to 450,000. So a lot of lead gets thrown around in a jungle, making a bunch of noise and not really achieving its objectives, apart from saying, hey, I'm here, go away. So it's almost like slapping planks to scare animals away. There was one key difference, a unique special force typically, was snipers. They were often lone or worked in pairs, possibly in fours. There would be spotter and sniper. These guys were actually ruthlessly efficient. And a couple of well set up snipers could hold up entire battalions in World War II. That happened in major towns and cities, and they took head counts. And the key reason when you look at the numbers there is that for every shot fired, for every 1.3 shots fired, there was one fatality, versus that 450,000 number. You could see a degree of efficiency. And one of the reasons why they achieved such a high level of efficiency is they fired a whole bunch less. These weren't the Uzi triggers on, automatic blatting into the walls and into the sky type guys. They only took a shot if they were almost in their minds 100% of the opinion that they had a dead, clean, fatal shot on a high-value target. In short, shooting a single infantryman just romping his way home is not even getting the spotter or the sniper interested. If they've got a rank, if they've got a leader, if they've got a specific profile, someone who's running a tank battalion, an officer, that becomes more important. So the key part of that is the transferability of that to trading. Most of the time it's churn and it's chop. Stop losses actually work against you because there's too much chop. And the core principles is there's only a rare moment when you can really have low volatility and get away with a super tight stop. Most instances, stops harvest and scalp losses. And they also have asymmetric, when you have these low volatility moments, they have asymmetric explosive moves that if you've got the direction right, you make a multiple many R's in the risk reward ratio basis versus what you would lose. And if you're wrong, it's a super tight stop and you scalp a small loss. And that's the analogy, the simplest form, without getting any deeper into the weeds of HVF method and where I ended up in terms of what suited my personality. And as someone, I wouldn't have said I was emotionally particularly robust. I got as high as a kite, just having a cup of coffee and bounce around and FOMO, just like any other old sod. And it took a lot of training to, contain that. So I'd actually say I was not even at a personality level. I've got a fast metabolism. I can be moody up and down. If I don't sleep well, I feel pain. I'm not one of these rigid, sturdy, steady guys that are consistently, the same person every single day, exactly, that are super, super stable. And so I think it's the best method for everybody because it gives you the highest emotional stability. Your winners must be held for a lot longer than your losses. By definition, your losses are taken quickly here, and your gains are running for an extended period, which allows lots of magic to happen to the upside. So that's HVF method. That's the journey I went on. And yeah, for much more, there's other materials you can watch. So that would be my answer.
That's pretty cool. I've never heard anyone say that before, that you shouldn't be in the market most of the time. That's probably pretty true. I like that a lot.
In terms of leverage specifically, bear in mind if you're an investor and a buy and hold, the opposite is almost true. If you miss the 10 best days in the stock market, you often lose 50, 60, and even 80% of the returns. So that I do differentiate there between investment holding. Many people that had insane amounts of Bitcoin in the early days have a lot less because they badly traded and wish they were back having all that Bitcoin and just held on. That's why you have this hodl thing, and the same for NVIDIA. So there are things that are just worth holding fundamentally or on a very big technical time frame that are going to reward you. And then off of that base, when you try to add that additional alpha that may involve utilizing leverage, you should be highly selective and very tight on money management and expecting great rewards because you're taking risk. And that's the philosophy. So I just add that differentiating fact.
Yeah. Okay, what is your macro view of the world economy and financial markets today?
Oh, excuse me. I'd like to share screen if I can. Whoops, sorry. As soon as you ask the big question, note how the frog pops into the throat and says, don't tell them, don't tell them. Yeah, forgive me for that. Let's have a look at this. This is the US 10-year chart I brought up here.
Okay, the benchmark for money here.
Yes, that's right. The cost of money.
Yeah.
And so when many people ask for my macro view, I have this habit of saying it's the debt collapse story stupid. It's a kind of like the Bill Clinton's, it's the economy stupid. Only I don't mean the stupid. I'm just paraphrasing. He's saying, not you or anybody else I refer that to, do I feel that I'm more intelligent than? I'm just saying this is the basic cornerstone of where we are macroeconomically. There is way too much, particularly American debt, but generally debt in most nations. And the interest payment that is going on that is too high and too large. And I've turned you to the US 10-year, and I'm showing actually a falling wedge. Now, we predicted that when you're around the 4%, that's that light blue line here. I'll just highlight that, and I've got a bit of an overlay draw. We said you're going to go all the way up to this red line and then likely turn down. And we said you could turn down all the way to our splitter, which is the small dotted line you might not quite be able to see. You might even get a full retracement. But the end game on whatever time frame they're bringing this event to is that you're going to break this red line to the upside and you're going to run the 5% mark. And the 5% mark is the dark blue line that we'd previously predicted would be run on a double bottom back here to my left on that same 4%, and you can see the targets there when that was made. So that was our last prediction on rates And on our overall view is, yes, you're going to pull back after 5%, but the structure that we're seeing is a 3-impulse falling wedge, and it breaks for higher. In short, overall, we've continued to assert interest rates on the long term are going to go higher for longer. The pullbacks are going to be shorter and less deep than expected. And eventually, we've stated that the markets are going to take rate setting out of the central bank's hands, which in the case of America is the Federal Reserve, Jay Powell, and his committee. And we're going now today, and it's brilliant that we're having this discussion. Steve, thank you for choosing this day to bring the Market Sniper for the first time onto your channel. It is the 19th of December, and a rate announcement is due today. We just checked it with yours truly, Grok, and he didn't lie, or I hope he didn't in this instance. And it's 95% expectation of a rate cut. And I want to highlight that. A rate cut in an environment where, and we're on a daily chart, Steve, you've literally had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days of solid upside swinging. And more importantly, you have just triggered the breakout of what we've called a falling wedge structure. I'll just highlight the falling wedge. Some people maybe not be technical analysis au fait. It's that capping descending grind line and that basing descending grind line. Between the two, we have a split in there. It's kind of a little bit faint. We don't want it to over dominate, and it's often a halfway mark, and that is a squeeze and a continuation pattern for further upside. This has come ahead of even my own expectations. I thought we would at least, I thought we could dip part of the way, but I thought there was a chance we would get to the 4% on a bit of a pullback. We were in a cutting cycle. They have been talking cuts. We could have even in a more chronic situation got into the bottom half and maybe even to the bottom of the bottom. There are all the interactions along the bottom that make this a falling wedge, by the way, over there. And here where the blue flags are all the interactions in the top. You have broken out, and you have broken out on the upside on rates on the day that a Federal Reserve chairman is cutting the rates. So this is determined by market, Steve. People are saying we want a higher yield, otherwise we're bidding lower. And they are bidding lower for the deflation of this debt bubble. It's too big, it has to be devalued. That's what Volcker essentially did with the Vietnam War debt that started in 64, ran all the way to 68 into the early 70s. Nixon then, when all the gold was being called, in 71, removed the gold backing in final stage. And then you went right the way, all the way to 82, to the mega highs of gold and hyper rates, very high rates, double-digit rates that Volcker did. And he crushed the value of that debt. In other words, over that period of a decade and a half, you reduced the size of what was an extreme debt valuation. However, the circumstances of back then are not the circumstances of today. And the debt to GDP is far higher, and that you will not get to the level of percentages without substantial reset economics collapses taking place. And we feel we've already identified one, which I'll refer to now. But the important part is the market is setting a rate that is going up in an environment that the person everybody believes sets the rates is actually going down. And that event we predicted. In short, people don't want bonds. And this is a reserve asset for 40 years that was a stabilizer for the alpha-seeking 60% in the 60-40 portfolio of equity, where you were reduced to this binary choice, bonds or equities. And what's happened is you now have a hypervalued equity market because all the money has been leaving bonds and rushing into equity. Some of it has now been finding its way into gold. And more recently, as we are looking for a new reserve asset, we already have one, it's gold. It used to be in portfolios to the degree of 5, 10, and even 20%. It got eliminated after the financialization of everything that happened with Greenspan. And now what's actually happening is we need to rediscover gold. But in actual fact, Trump is now saying a reserve asset Bitcoin. And he uses the phrase, very key to do this, because now he's joining everybody's dots. This will become a reserve asset. Government has decreed such, which means they are going to become bidders. They're going to pump Michael Saylor's bags, so he won't have to be the guy doing all the buying. And Bitcoin is being planted in front of gold to get all the escaping money from a collapsing bond market by valuation. Rates up, value down, bonds. That's the key key thing that's happening, and it's even surpassing my expectation. We are broken early towards what my best guess would have been.
Huh. Well, you're really making me question. I have a tiny percentage. It's like 1 or 2% in intermediate term government bonds as kind of a hold through this cutting cycle. And now I am seriously questioning that. Maybe that is not the thing to hold right now. I'd rather have cash.
Debt, ostensibly in any form, corporate debt, commercial property debt, government debt of any nation. I'm not picking on the Americans. They are, of course, the world currency unit does sit in the dollar. So that's why it's getting extra relevance. But debt generally is going to prove to be one of the worst asset classes for the next decade and a half, assuming it doesn't even get zeroized or some sort of proxy payment in compensation post some trauma event and introduction of new financial system doesn't take place. In fact, I've got a chart. People are very visual, and we have a male audience. We're all visual. And even your ladies will understand this as well. We're visual too. The Jupiter represents fiat that is borrowed into existence.
Okay.
And US Treasuries is the other half of that T accounting equation. You borrow money into, you buy a house, a bank creates money. It's not taking from somebody else. It creates an extension. You push up the value of property markets by being a bidder, an additional bidder in the market, and you buy up and you create a debt instrument. So that money then goes in dollars to you. You also then transfer it from dollars into a property asset. And I have to say, for the US, for the Australians, for the UK, very property dominant nations, of course, New Zealand not far off in that mix as well. Property also is going to be a very poorly performing asset class because of, I know it's physical, I know it's non-digital for now, providing tokenization isn't imported, which I think it will be in due course, but it is rate dependent because too many people use debt to purchase, most people. So if the property market was 100% supported on no financing, everybody paid what they had saved, you would not have that same exposure. The problem is if debt is collapsing and we get a super cycle of interest rate hikes, these are going to lead to property being a bad asset. I'll cover that in another diagram, but what we actually see is the shrinking down of the treasuries, gilts, and fiat market. So your money is going to accelerate in its loss of buying power as a result of these interest rate hikes, because that means a greater payment in the US of your tax revenues is now going to the cartel of bankers that are being paid for being given the executive privilege of borrowing and the nation's money into existence. That means less money on your roads, airports, healthcare. You're going to get squeezed to the benefit of the recipients of those interest rate payments. Of course, your military industrial complex needs a lot of money, needs maintenance. Things are going to start going behind. You're going to have less money for everything else. They're going to look for more taxes, which is why things like unrealized capital gains and things like that were being mooted. It's not just going to be a leftist thing. So they're going to be looking for more money, and people need to bridge their assets that are in the traditional system, bank money, treasuries, bond portfolios. They need to bridge them into gold, silver, and I'm afraid to say you probably need to participate, but in a sane way, without too much leverage, in the crypto inflation, because we see this market cap expanding immensely. Don't forget, they're using Donald Trump as the pivot puppet to now say we're ready to do digitized money. And in actual fact, you've gone from Bitcoin being a tool of liberty to now, hey, Trump and BlackRock, pump my bags, please, which of course is governments and pretty much a very dominant statist capitalist entity that is behind, the LGBTQ agenda, the DEI, the climate change, and all of those things. So we've gone from liberty to relying on the statist institutions to now turn and grow these things by value. So participate in it to make the money. Hold your nose, do not a believer be. Ensure you keep washing some of that into the more stable gold and later silver when that turns. Because the end game is a full deflation, and I'll put it like a football there, a full deflation of the legacy markets, the legacy system. We're going to parallel run for a while, and slowly only those that stayed in the old system are eventually going to be very poorly compensated, probably with some token or CBDC, which will have significantly less buying power than they would have had if you jumped early. This is one of those situations. The ship's going down. Don't be the last to jump. The value of getting warm and dry in a lifeboat earlier is far better than extensive exposure in the cold water and maybe not getting a seat on the alternative system in time. And the asset classes, Steve, that's prevailing at the moment are bond markets, the traditional markets. We see this contracting. That's the red arrows here. This all contracting. We're seeing flows into gold. Gold moved first before crypto. Then we saw it coming into Bitcoin. We've also seen some of that roll into the likes of XRP and some of the status tokens that will be the new railway for your surveillance finance digital system. And property is actually going to leak money. Guys that have got 0 down, 10 property portfolios that they're Airbnb-ing, as the consumer gets wrecked, they can pay less rent, they're taking less holidays, their income goes down. At the same time, you're seeing the 10-year rate go up, mortgage finance is going to go up, you're going to need to sell, few people are going to have the means to buy because the interest rates have gone up, it's no longer such good value, they're going to have a bigger payment, etc., etc. So real estate is very, very compromised, particularly commercial, but even resi as well. So positioning for this period of interest rate spike, we have an interest rate spike theory. We think this is going to be driven by America. You're seeing it take place. And what that's also done, Steve, is it's made the dollar stronger because it's paying a higher interest rate.
Yeah.
There are certain people that will make, great, look at us, America's winning, dollar stronger. No, your debt market is collapsing even more than everyone else, and you're forced to pay higher yields. The valuation is going down. So while you can take some respite on that, and it'll protect you on inflation on imported goods for a while, it's going to lead to contagion in the FX currency markets. And I think the first one that's struggling with that's starting to happen, is quite ironically in the first world nations. I'm not going to take you into the emerging market weeds. There's lots going on there. Is actually the Korean won, which is the home of companies like Samsung, Hyundai, Kia, etc. These big brands. And we just had a major triggering of the USD versus the Korean won. And this is a 30-year formation setup that we have been tracking for the last decade. Since it was around here, we've been tracking this. It is huge, and it has triggered, it's taken out that third high, and we expect it to halve in dollar terms. So there will be, part of that is the dollar strength that's causing grief, and that's going to lead to contagion in career-related specifics. So they could have a banking failure, a debt failure. They have some unique financing that they do on rental properties. You could see a bit of a Ponzi-nomics coming short there. That could lead to contagion on other Asian currencies. The USD JPY is trading back up again now. You're seeing a lot. But Korean currency is particularly weak. It could be the first of the major first worldy nations to have a bit of a currency crisis, and we see it halvening to the dollar. So the dollar is going to be predominantly generally strong on account of those rates based on the debt devaluation that they need. And this is going to lean on a number of first world nations, not to mention the Turkeys of this world and all the emerging nations that are going to battle paying back dollar denominated debt.
Interesting. So how can we bet on this and make money?
You need to go long dollar against the likes of the won, for example, on the basis of this triggering event. By the way, a 50% fall on loss of value is high for a first world currency. People don't realize what a massive, and there can be overperformance to that. So we're talking it's at 1440s, 45. We're talking a run through 2,740 going 2.8, and then you can have a blow off. And by the way, in case you thought, well, that's a bit exceptional, when has it happened before? It happened before in time for the Asian crisis over here, 96s, and you had a super shoot from 780 odd. The target was 1,054, which was a 50% loss. And just to highlight the overperformance in a blow-off set of affairs, you actually went to 1,850. So the target only captured 1/3 of the move. Now, I'm not going to suggest this target will only capture 1/3 of the move. Things rhyme, they aren't exactly the same. But when you get into absolute capitulation and hyper emotion, and all the Koreans escaping into $1, Swiss francs, all the high net worths running into cryptos or anything else but their own local currency, you're likely to have a highly emotive set of circumstances. It's probably going to have some geopolitical mix mash. They almost, I don't know if they officially or they threatened or they declared martial law. There's also geopolitics that are unique to the Korean won. It could be the first casualty of a dollar strength period based on a debt collapse interest rate spike. And this is all happening now. This is a 30-year period of compression of volatility on this pair.
Yeah.
That is now breaking out to a new level. And we are known for being early and the first for capturing big moves. And that's why we watch them before they happen. And we've been tracking this guy for a decade.
Yeah. Okay. So you would long dollar, short the what would your time frame be on the short?
Difficult to say. You've got to remember this has taken a long time in setup. This is a monthly chart. This is super macro. This is eagle in the sky looking down over the entire mountain range.
Yeah.
So you've got to be prepared to hold on, and there are carry costs associated with that. But the interest rate differentials I would say don't forget the other point to add on the Korean won. They made the mistake very similar to Jay. End of November, I think it was the 28th, call me a liar for a day either way. They cut by a quarter point. And that was considered an unexpected move. So you have an unexpected move. So it's well and good that Jay's cutting and everyone expects it. It's far more dangerous to do the same degree of cut, but in an environment where everyone thought you'd hold and you're watching inflation, because that puts pressure on the currency immediately. So it's a perfect setup for things to go wrong. Add the political uncertainty, quite a high debt, even though it's a sophisticated society, and you could get a little bit of a panic coming in downtown Seoul and South Korea. Hope to be wrong, not taking any glee or joy about this, but this is the situation and the mechanisms we see. We're problem shooters. We're early, and we aim, and we snipe, and we wait. None of this has been a trade until that point. Literally, you can put the telescopic sights. I can choose the orange and finish the draw for you there. That is a long for us right there. Sniper sights right on that event. That is the first key triggering event of any meaningful level for this 30 years that would lead to a meaningful asymmetric mega potential move to the upside. And just to further this, to give you an indication of what we do, when we're getting close to such an event and we're watching, the spotters are watching, we're looking through the scope, we've put one up and clocked the bolt, but the finger's not in the trigger caseway. We are holding and we're waiting. We actually had a smaller fractal setting up, and that was a squeeze on a much lower time. So I've gone from a monthly chart literally to an hourly chart. And we said, if this breaks this target and cracks on, as I think it might do, it's going to trigger the bigger one. That happened. So you often get this smaller time frame. So essentially, guys could have got long earlier and have a stop down here, which is actually very, very close. And if you calculate the risk rewards on this, Steve, you're talking through 100. I can almost guarantee you, because you're looking at longs at 1434. And in actual fact, in anticipation of that, I'll just show a small screen. You can see all my personal entries have started even before that, when we had that initial spike on the announcement of, on the announcement of the potential martial law situation. And then we got this fractal set up, and we've kept peppering this for buys, and I've added a few post that event. Why? Because we're now no longer just trading the small setup on an hour. It's triggered. You've tripped the wire for the 10-second hand grenade to go off now.
Yeah.
You are playing by the borderline. You walk that line. The pineapple's going to explode. And that's kind of where we're at on that. So kind of interesting trade, but it's one example. By the way, the other examples, because I've only spoken about the one, you asked the question, how do we play this? Get out of debt, get out of bonds. Interest rates are going to go up. If you can't pay off debt, fix it at whatever price you can get. It'll take them a while to get some form of force majeure and renege on the contract if you get it fixed. That'll protect you in the meantime. I would, as an American, as a UK, as an Australian and New Zealander, believe you me, eventually property market runs do come to an end. People in UK and Australia, get out, sell, pay off your debt, interest rate spikes, particularly if you're on variables or discounts, because you're going to rely on someone that you say, well, I'm fine, I've got a fixed deal. Hold on, if you ever need to sell because you lose your job, the guy who has to buy isn't going to get the fixed rate deal you currently have. He's going to get offered something way up here once the rates are spiking. And that's what everyone's going to have to match the US. As an example, by the way, the events of the UK pension and pound crash that accompanied the lady's name, the Truss, Liz Truss, was exactly that. The Bank of England actually was as much responsible. They blamed it all on her because she went a stimulus budget. She stopped wanting to tax. She actually wanted to give some tax money back, even though they were overspending, and to give stimulus to get people growing and investing and doing that. It wasn't actually a bad idea. They should have maybe given her a bit more runway for that, but they threw her under the bus and they said, no, the pound and the collapse. The pensions couldn't meet their pension obligations, so we're trying to sell debt, and no one was buying it at that price. And their option would have been chase the rack down and collapse the debt market, or cry for help. They picked up the phone and said, we need to sell this debt. We can't meet pension requirements. So guess what? They got offered more debt as collateral against that to meet their pension requirements. Don't crash the debt market. Whatever you do, don't chase the rack down. So everybody is keeping up a debt Ponzi right now. And it's universal, but America is the most significant one because it backs the most significant currency. It's the biggest economy, and it's hitting the wall. And I think this is a bit of a hand grenade for post Donald Trump's inauguration ceremony that could well see him have a baptism of fire on his second term.
Okay, get out of debt. I like that. And yeah, that makes sense as well, because we are the reserve currency. When I say we, I mean the U.S. So that one would be the one that rules all the currencies.
Gold, Bitcoin, crypto. Engage in that as much as you might have moral aversions. It's about your financial survival. I mean, let's talk about Apple, Nvidia, Microsoft. These guys are all been working for the surveillance state for a long, long time. But you would have been a lot better if you had bought and been net long the Mag 7 over the last 2 decades. Facebook, a lot of them. It's not about what you like or don't like, or you claim to morally support. I didn't support Apple. I didn't support any of them. It went up to trillion market caps anyway. It didn't need my endorsement to do that. And I'm here to tell you it's going to be the exact same for the new digital system that they have to inflate up. Remember, as the one deflates, the rich aren't going to have their money all ironed out. They have transported and already positioned in the new system, and they're going to have those assets reinflated in lieu of compensation for what they're losing on the other hand. So it's kind of like the baton is being passed. They don't let go of it until they've already got a hand on the other end. Then they let go. So that way they're never dispossessed. And this is what's going down in my take, Steve. And this is a debt-based collapse. And it starts in the US. The head of the Fed is cutting and the rate is going up, and it's breaking out of a technical. You will trade above 5 is our prediction. It has been, and it's coming sooner than I thought.
Okay. Well, I'm selling those bonds. That's enough for me. Okay. What can you pull up the chart of S&P 500? Let's look at the dollar. We had some pretty interesting moves when Jerome cut the 25 basis points. What do you see on those charts?
This is a fascinating chart. I'm going to go let's make sure I'm sharing again. This is a fascinating chart because it met all our inverted HVF criteria. I've been more heavily engaged now in crypto because of the alpha it's offering. It also wet the bed badly yesterday. Mm-hmm. Again, the notion that this new asset class is immune from the macro is a false one. But the S&P, beautiful little inverted HVF after making its final high here.
Okay, this is the 2-hour chart. So every bar is 2 hours, right?
That's right. So I'm on a 2-hour chart. Correct. Thanks for making me explain that. This is overperformance with a tight stop. You get in there and it's down, down, down. And it's the first in a new trend, which implies for us over performance. And this is what you've got so far in the performance. Look, you might get a bit of plunge protection rally buying that might set up a flag and you think it's all over, only to see another wave of selling. Typically, when you get big hit selling, you often come in threes. So you could get a spell of rally today and sell, or if it's really scary, it could continue to fall off. But that is an inverted HVF structure. It's a volatility squeeze after a final high where you fail to make a new high and you keep making progressively lower ones and you're holding a level. And the level here is the 600 on the SPY. It's very much the 600. You're at about 602 there, about 602.5, 603 where you broke, and you're down now at 586. So there could be more in this, and it's dollar strength. But remember, Americans will say, what's wrong with our currency getting strong? It's awesome. It's the collapse of the debt market you should be worrying about that's driving that strength because of interest rates escalating in the real market, the place where people buy and sell, the price discovery mechanism, where people are saying we don't want that reserve asset anymore. It peaked in 2020 when you printed all those trillions and scared the bejesus into everyone and all the money ran into the bond market. It's peaked. It's turned. And 40 years of escalator, you're going to have 6 or 7 years of absolute elevator. It's already done that. And just to hit that point home, I'm going to highlight the TLT, which is an ETF of long-term debt, which I often get out as a proxy to show you how your debt markets have actually performed. And this is a call we made again in 2020 and on a head and shoulder and before the head and shoulder, that this was likely to be a blow off top on the debt market. So this is not the yields like the 10-year, this is the valuation. And you can see how that increase in rates, and you're in a rising wedge. So perfectly in opposites of the falling wedge on the 10-year, you actually had a rising wedge here, and we've been calling this to break down. It tested down, return move, and is spilling. This makes new lows past this, Steve. That means debt collapse. And if you look at this from here, you're up at 180, and you're now at 89. This was supposed to be a boring asset that incrementally had capital gains and paid a reasonable yield. That yield got crushed over 40 years from the Volcker highs in rates, right down Greenspan ever cutting the liquidity experiment, the follow through that everyone else did, to the point where it was 0.3 in rates because there was so much fear. By the way, Switzerland, it was Austria, actually got a near zero 100-year bond away. That thing's value is negligible. The guys that sold that one did a deal of a lifetime. If they put that in Bitcoin, they'd be really smiling, or XRP. Unfortunately, debt is very much a busted flush. That makes gold the reserve asset. That's what the central banks have been buying. But Trump is quite keen to position the digital version of gold, they believe, they assess on a basis of digital scarcity versus real physical scarcity. I question that, but that's going to be put in front of you. And you're going to have the likes of MicroStrategy and the US government being a new bid. And then people will still say, this is your Liberty token. Believe you me, people that own a lot of it, like BlackRock, Michael Saylor, and the US government will exert control over this asset. And I know people say, well, it's not the miners, it's the nodes and all of this. Let me tell you, this is not Freedom Coin.
Yeah. Okay, how about the dollar, the DXY? We had a jump in that thing yesterday that is pretty interesting.
And that truly is it. Remember, the DXY is mainly being measured against the euro, which is far from a great currency of its own. But I will take you there because you've asked for it. And this is, again, the point we're making. It should be showing up across the board, and it is. You've seen since you almost made 100, you almost fell to 2 digits there way back in September. You're now at 108 on the Dixie. And this goes higher as long as that 10-year and others like it continue to work their way up. So debt is being sold. And can I say, we said this in 2020 when that termed, but more recently we've had the endorsement of Stanley Druckenmiller, Paul Tudor Jones, all saying long commodities, long Bitcoin, long gold, short debt. They've said words to the effect of Paul Tudor Jones quite specifically, Stanley Druckenmiller quite clearly implied. So this goes higher on the interest rate. So the dollar is strong. Even if you measure the dollar, I'm going to take you away from the euro, it's about 53% of that, to something that's considered a very solid currency in the world of fiats, where nothing is truly solid. You can see the dollar has been advancing as well against the Swiss franc since then.
Yeah.
As well. And even if you look at the Singapore dollar as an alternative, you'll find, again, the dollar is gaining ground. But the Korean won as a first world currency is really in trouble. There's the Singapore dollar, another nation that's typically considered the Switzerland of the East. Another big move. You've come off real lows at 128 and you're right up at 136. You could start making relative highs beyond these levels if this is to continue. Again, interest rate debt driven. Powell is cutting. This is going up on an interest rate climb on your debt markets.
Yeah. Okay. What do you see on the gold chart?
Yeah, happy to take you past the precious metals. So what you'll understand, particularly after having a pretty good year and a good run, is that strong dollar is not particularly helpful for gold.
Mm-hmm.
We gave the key moment of chase on the breakout of the 2K. We said it's always going to be a significant level. You'll be rejected a lot of times. In fact, let's go out a bigger time frame or in a daily there. Start on the weekly and drill down. This was all a continuation pattern. We continued to assert it. Gold guys were getting super frustrated though during this period. It's all one big broadening structure continuation. There's the splitter. That top part was across the 2K, and then the bottom was down here. We said when you break and you sit on the 2K like support, that's when you're about to start going. That happened there. So, and that was the best part of the gold run of this year. And I'll take you back now to that daily now that we've explained that. And we're still long. That was we get in super tight on this upside HVF that we drew here with a stop there. And we are still long. But, you know, it's not a straight line journey. You got bad smack there. There was a little head and shoulder on that one. You tried a rally. You grinded a little bit. You made a double top here. And you're being smacked again down by the strong dollar. So gold hasn't got its own impetus right now because Bitcoin has been stealing the other reserve asset. Before that, it was the central banks that were the primary buyers, and they were resolutely buying gold. So when it comes to the top tier bankers, they know what they want for collateral. As we've got more into the hedge funds, the institutions, and now BlackRock saying you should have 1 or 2% in Bitcoin or cryptos, and you've actually had private bankers saying to their traditional clients that are in portfolios saying it's time to start considering crypto. This new thing isn't going away. So we've had a bit of a crypto run. It's come a tiny bit at the expense of gold, but you can see the dollar being dominant hasn't helped gold. We have been in this channel up all the way. It remains to be seen whether this will stop here. I think we could spill out of it if this gains momentum. If this gains momentum, we could have a deeper pullback. But that could point to a nasty time in the stock market. The stock market is overvalued. Essentially, we got the financial system reduced to being a binary equation. As I said before, you used to have 20% gold or 10 and 5%. It eventually got reduced to the 60-40 portfolio. And the bonds did a little bit better when there was fear in the stock market because you washed the money from the one side into the other. That's not going to happen anymore. So you're having a hyper-valued stock market in compensation. That's the perfect setup for a crash. Daniel DiMartino Booth, who I'll be having a chat with later on, I think, has been highlighting that in the last we're in the top 1% of time periods for equity valuations by all metrics, PE ratios, CAPE ratios, valuation to sales, market cap to sales levels, all of these things. And that's because people have been given a choice of the collapsing debt market that no longer give you the risk-adjusted stability with small, steady growth. They now can lose 40 or 50%. That ain't right. You are supposed to be the stable guy. We ain't doing you anymore. So they all crowd into the equity space, overvalued equities. And eventually that sets up a potential crash as the interest rate spike starts to cause contagion on the other currencies of the world that have dollar-denominated debt. So to that sense, we could be having a real global slowdown. We've spoken of a demand-destroying event, and that unruly interest rate movement. Debt markets are the thing. And you aren't taught about debt markets. Everybody understands crypto, buy Coca-Cola, Microsoft products. We get that. People don't understand debt markets. It is the underpinning and the fulcrum foundational layer of this pyramid that is fiat system. Currency and debt go hand in hand. You borrow money into existence. And that is in a state of real disrepair.
Yeah. You mentioned a pattern HVF. What is that?
So that's our recognized methodology, the Hunt Volatility Funnel theory. That's part and parcel of trading extremely low volatility into hyper expansions. The unique trait about volatility is once it's been introduced and is very volatile, it dissipates very slowly. It has to calm down. Once it gets extremely calm, very low vol, instead of slowly winding up, it explodes up. In other words, at a point of very low calmness, you're likely to have a detonation. And that gives you the fast moving breakouts that take you away from your tight stop well into profit in a short time frame. That immediately brings emotional comfort. Remember, I'm not an emotionally stable guy. Quite a confession. My name is Francis. I am emotionally unstable. No, in terms of trading and understanding that, it gives great comfort for you in that sense to have your trades quickly and soon move in your favor. And when we're wrong, Steve, we're 180 degrees wrong. It means it's gone real quiet. And instead of melting up, it's breaking down. But you pay the same amount for being bloody wrong as you do when you're just somewhat wrong. So there's no extra punishment for getting the market entirely 180 degrees wrong. Wrong is wrong.
Yeah, you just got a tight stop.
100%.
Okay. Could you pull up the silver chart?
Happy to pull up all the charts you have in interest. As you've brought up silver, I want to just bring up something before silver to give the context on silver. And this is our concern that precious metals guys have a little bit less liked and has seen me spend, because we gave a lot of attention to precious metals in the beginning part of this year. We saw this key break. We saw that gold had to move first before cryptos could move, yada, yada, yada. Gold did the run. But then we said, okay, guys, we had a fake out on the gold silver ratio. So what I've actually brought up, you've asked for silver and I've not given it to you. It's coming. I'm just asking you to wait, is that this break never followed through. And in actual fact, there's a reframing for this pattern. And I've since been saying the red line is always the line I expect to break. By the way, thank you for asking for this, because I haven't checked the gold silver ratio in a couple of days. In the same way, the Korean won is in a breakout of a falling wedge. The gold silver ratio is in a breakout of a similar constriction. I wouldn't say it's a perfect falling wedge. It is kind of a symmetrical triangle of sorts. But we have been resisted every time we come up to that capping descending grind line and turn down. And you can see twice there. So you've had the better part of 5 times. This is currently a break. That means silver is going down more than gold in an environment where gold is already losing value. That is in an environment of strong dollar, real concerns about debt. Now, I don't expect that to last forever, but we expected this to break up. That's why we're not yet wailing into silver and saying leveraged longs on silver and buying every silver miner just yet. You've got to let this full story play out. And there's many, many twists and turns. Don't jump the stages too soon. If you jump the shark to silver and silver miners before it's played out, all the dominoes having to fall, you get there too soon. You watch everything else run around you. You get red. You have red ink on your books, and you end up waiting the entire cycle just to catch the last bit at the end. You've got to play through the stages in a stage-based collapse. The debt is going to cause fear. Fear is going to see everything that's not nailed down sold. Even gold will go down, but less so than silver. If we're about to hit a fear stage, you don't want to be 100% long silver and have got rid of all your gold. Gold will hold better, and even fiat cash, not in a bank, I would say, but physical cash, most of us will have to have something in a bank, will hold up better in that fear period. But that doesn't mean you go running back into debt, although many will. It's no longer the safe haven that it was put out to be. And this breakout to the upside here is telling me that the gold-silver ratio is going in the wrong direction. In terms of my desire to accumulate more silver, I'm not there yet. It's not the time. Over a period of time, it might come back down. I needed to break the 75, this light blue line, and then be heading to the 65. Then we're off to the races, and I could see literally right down to single digits being possible. But we're far, far away from that. We're moving to the upside. Okay, that's a key comment on the gold-silver ratio. It does kind of answer your silver question, but you did ask for the silver chart. So I will give it to you and we'll cover it quickly, because I think that ratio analysis has shown you what I'm saying. In short,
yeah, you see one downside for silver.
Yes, we're going to pull back in. We're going to pull back into the structure. We love this green line, but it did a breakout and it's feigning back in. On a much bigger time frame, we have a huge structure for silver that is to the upside, by the way. It's massive. So I almost need a 6-month chart for this. But this is a huge, huge structure. So don't get me wrong. I haven't turned all evil eye on silver. I'm just saying you want to be just in time entry, because there's opportunities for those cash to make alpha elsewhere while this is going down. Why red? So this is your breakout point. And we have already had one of the stage 1, which is typically a technical break of it, but then a fear and a scurry back into the womb of the funnel before it's getting the real breakout that comes subsequently. It's quite typical this. You don't go up in straight lines. So there's a cycle to play out here still for silver, and you could accumulate more at lower prices for now. So that's not what many precious metals guys want to hear. I consider myself a sound money man. I'm not dissing precious metals. I have more precious metals than I have crypto because of the stability it brings to have in your portfolio. But gold would be the better accumulate right now. You can rotate into silver from gold as we get that turning in the gold-silver ratio. So silver to be weak for a bit now after it's run up to its highs. I think they were about 34.8.
Okay. What do you see on the copper chart?
Copper's an interesting one. In fact, we've done some analysis of silver versus gold. And the key interesting thing is that in some ways, silver sometimes has a sort of hybridized price-based reaction that is the gold and copper chart merged together. Funny enough, copper is holding up better right now than silver is. Yeah. But silver had made at 34.8. It's not an all-time high, but in terms of the last decade or two, that's the highest it's been in a very long time. Copper's closer to the lows here. I would say that it's close to, again, and we've just done this in red. You can see we've done most of this analysis. This is an industrial version, a super industrial version of silver that already has some industry in it. It has some jewelry, it has some precious metals in it, storage, bullion. But copper is almost largely, except for the Chinese that do store it as a money composite, it's largely industrial use. And I personally feel that industry generally is weak. Consumer is weak. Retail is weak. Outside of the military industrial complex, possibly the pharmaceutical industrial complex, everything that is statist and getting money. So obviously server farms are going up in value a lot, but other commercial property is not. For businesses in New York, they've never had more space to rent from. But if you're Amazon building server farms for the surveillance financial grid, that's going up. So as I say, outside of the industries that government has steered a lot of contracts to, and mega corporates like those that are working with government. So Elon's businesses, SpaceX, which are being paid by the government for satellites, all of that, they're in their own little bubble economy that you and I are not included in. Outside of them, this is showing to me a weak general business. So if you're not doing business with the statists, and you're not in the cool industries, AI and other tech-related, social media-related items, you're not doing that great. And I would anticipate that copper could break that red line. We always put the red line where we expect the break. This is a bit of a rising wedge, and you're leaning a little bit hard. Could be proven wrong. It's not a clear enough trade for me right now. It's not a strong opinion. I'm just saying you're clinging to the line here, and it's been grinding up. And you're getting an ever weaker environment, and you're actually getting the market signaling higher rates in an environment where the Fed seems to no longer pay attention to the people who have to buy the debt that the Treasury is creating. So you've got a divergence. You get it in technical analysis, when the momentum is actually turning down, but the price seems to have made higher. It's kind of like the road runner who's run off the cliff and hasn't looked down yet. It's a precarious possible moment. So for me, I would be cautious on that. Long run, in terms of all their plans, macro commodity bull, but not such a big fan of energies and copper. Big fan in commodities for those. So the other part of the trade, we've spoken of Bitcoin, gold. The things that I do talk about also that haven't been mentioned is cocoa, Arabica, and Robusta coffee. These guys are absolutely screaming up. And our community has actively traded them, done quite well. We missed the last pullback. And I'm quite happily show you that as well, because it's not something that's regularly referred to amongst many. But these have been runaway bull markets, and they are highly inflationary. So again, further to my point, your dollar's buying power, and never mind the currencies that are going to go even weaker to the dollar, are just not going to pay. Your chocolate bar is not going to cost the same. Your coffee beverage in the morning, Starbucks, wherever you buy it. I hope you don't buy it from there, actually. Better coffee is available. Other vendors are available. I better be careful. I don't want to get you into trouble. But yeah, this falling wedge, we went in there twice. I went in there thinking it had broken. I got flushed out. I got in there thinking it had broken, got flushed out, got in there, flushed out, and then I missed the move. But we'd had a very good run earlier along here, and I was lucky enough to have had a very good run in cocoa as well. So this is a daily chart. I can even do the weekly here and just pull it through, but this thing has absolutely rocketed. And it's not. We've been in an internal flood or dry spell and the crops aren't doing it. A lot of the time, the mainstream media, Bloomberg and many others amongst them will go, oh, Brazil had that, and Ghana, this, and Vietnam that, whenever it beans. And it's like, oh, it's kind of, and the minute people have a reason, they just latch onto something and parrot, repeat it. The news said, garbage. We haven't had since June 22 floods and famine and dry and droughts the whole time. This is your money devaluation I'm talking about. It takes place in different things at different times, and it's the exact same for coffee. And many of your viewers will, of course, be enjoying a good beverage. Let's do Arabica first, which is the milder bean. And in the futures, you'll see this guy is absolutely ripping as well. And by the way, we called this particular one too. Let me get it up. Come on. Battling to find my let's do it like that. It's KC1. There you go. Now you're finding it. We actually called this double bottom 8 months ago and said, there's a little squeezy Japanesey, as we like to say, get in long here with a very tight stop. Well, that smashed our 300 highest target already and is going higher. In 8 months, you've gone from 180 to 300. That's going to start coming through at the checkout counter, Steve.
Yeah.
You heard it here first. All your viewers, you're breaking big news right here. Your central perk in America, your coffee beverage, it's getting more expensive. Your chocolate bar, your mug of cocoa, it's getting more expensive. This is the more expensive bean, a Robusta bean, which is this guy, which is the capable of growing a little bit. It's a little bit tougher tree. It's more robust. That's why it's called that. Had its own reversal way down here. We were in on that. You can see this TA, we've had it on. We leave all our research on here. This is what we've been doing. If you want to make money, here's what I'm showing you. We've made some money on this. We had a great run. Of course, things rest after they make that initial inverted head and shoulder target over there. You get a pullback. Then you get a nice up leg. Then you get a flag. This is TA done by someone who is a macro technical analyst and loves doing TA. And the clue is in the target. We had a huge target up top here, 5,500. You wouldn't have believed me if I said in very close to mid-year 2021 that by 2024, you're going to be 4.5 times more expensive on the cheapest bean. They often do blends with this one. It's got quite a kick. It's a little bit tougher. It's less smooth. It's a robust bean. It can be grown higher up and closer, lower down at sea level. Arabica tends to need to be at, the 250 feet, or is it feet or meters? Call me a liar. I'm not too sure. I'll have to check my facts. And 500. You can't grow too high. It's too cold. You can't grow too low. This guy's the cheaper version of the bean, and it's literally gone from 1.4 bang through 5,000.
I was tracking those for a while when I was in Nestle for a hot minute, and they use the coffee and cocoa quite a bit. So thank you for that, Francis. Master class in technical analysis. If our viewers want to follow you and your work, how can they do so?
Oh, thank you for that. Yes. Well, quite simple. We run 2 YouTube channels. The Crypto Sniper, we did that separately because it was a separate universe. The Crypto Sniper on YouTube and on X under the same name. The Market Sniper for the traditional markets, which includes futures, indices, you name it, everything else, FX. We've discussed quite a few asset classes here today. That's the Market Sniper as well. In the notes, there's an opportunity to book a call if you're interested. And we have a free course that you can get a little bit of the basics. I kind of gave you just a touch of in discussing, and you can see how it's worked for us. And you can go grab that. You'll be in our list. You'll get our monthly newsletter for that, and you'll get a video a day for, I think, 2 weeks, which will just give you 5 minutes each morning of building on what we learn. Grab that free course. Decide if you like the cut of our jib, then book a call. By the way, we've been in this space since 2009 on the Market Sniper YouTube channel. Check us out on Trustpilot. Our people are very kind and give us great reviews. And the goal is building wealth in reset times. Guys, this isn't a normal economic environment. Your IFA, your independent financial advisor, your insurance salesman, whatever he is, wherever you are, that tells you what he thinks you should buy. All of that is likely to be incorrect. I'm not regulated like they are. I'm telling you, it's time for reset. Self-prepared, self-reliant decisions that you must make. The old system is dying. Don't be left to be last to switch the light off. It's going to be a very, very costly mistake. Our most famous video we did on the hill in Canary Wharf, in a place called Greenwich, the UK, where the timeline is split for East and West. And we said there is going to be a parting, a separation along this line between those that took the right steps, a polarization in wealth. There's going to become a working poor class of great scale that are going to be taken out by the events that are coming. And those that do exactly the right thing will have a huge opportunity. This is a seismic financial dividing and polarizing event. That video is huge. It's been watched I don't know how many million times. Go and ensure that you don't get caught out by that. At the same time, I'm not here to black pill and misery people. This is a great opportunity and a great time to be alive. Economic case history is being made of 500 years relevance. They'll be thinking back, what did you do? If you play this game, it's an obstacle course. We've all got to run it. You were chosen to run this because you're big enough and strong enough. Don't curl up in a ball and weep. Get up and win this game. Gamify this. Bring it down. You can take active steps starting today to build your future. It starts now. Small little individual things. And we're there for that person who understands that concept. Thank you for having me on. It was great chatting with you.
I already know what I'm going to do. I'm going to sell those bonds. So thank you for your time. We will put all your links down in the show notes. And if you Francis a call, be sure to tell him In It to Win It sent you. Thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.